funsupermart.com.
What is your outlook on Asia ex-Japan equities in the next 2 to 3 years?
We are cautiously optimistic on Asia ex-Japan, backed by a combination of stable economic conditions and improving domestic and global demands. We also believe that the improving infrastructure and favorable policies will continue to bolster the consumption growth in the Asia ex-Japan region. In fact, we foresee the recent sell down on the Asia ex-Japan equity market as a good buying opportunity for the next 2 to 3 years, as valuations has fallen to more attractive levels. We would not be overly concerned about the prospect for a tapering of the quantitative easing in the US, as we believe it will be done on a gradual basis without seriously harming the Asia ex-Japan equity markets.
Within Asia ex-Japan, what are some of the countries that investors have neglected which have a higher potential for outperformance for the remaining of 2013?
Okay, in the Asia ex-Japan region, we are bullish on the Hong Kong-China market due to its undemanding valuations, where both price to book and price to earning ratio are trading below their long-term historical averages. Although there are signs that China is facing an economic slowdown, we believe China would avoid a hard landing. In fact, China's projected GDP growth is still one of the highest in the world, and it may be unjustifiable for the Hong Kong-China equity markets to trade at their historical lows.
Conversely, which countries within Asia ex-Japan do you have the least conviction for the remaining of 2013?
For the moment, we prefer to hold a neutral view on Thailand, Indonesia and Philippines. We feel that most of the bad news are already factored in markets, and we do not foresee much froth from their valuations. There are, however, concerns that this could be potential downside risk. For Thailand, we are concerned about the slowdown in the domestic consumption and its exports. The Bank of Thailand has cut its estimate for GDP growth for this year to 4.2% from 5.1%. China's much publicized slowdown may not immediately be good for Thailand's export growth. For Indonesia, the main issues are inflationary pressures given the withdrawal of the fuel and potentially other subsidies, and depreciating rupiah. In addition, Indonesia still faces a negative trade balance due to its exports affected by weak commodity prices. Further down the road, a presidential election looms. For the Philippines, we are mainly concerned about its high market valuation despite its recent investment upgrade. The current P is about just under 20 times against the 10-year average of 15 times.
With China's economy slowing down, how do you expect this situation to play out?
We think the markets have reacted without any panic to China's slowdown and to its impending period of lower growth. Despite the prospects of years of slower growth ahead, which in the long run is a good thing, China is still leading growth in the region. Its huge population, continuing urbanization and healthy domestic consumption underpin domestic economic growth rate that will continue to support the smaller regional economies in Southeast Asia over the long term. We think that the Chinese government has the tools and means to transition the country from its decades of high-paced growth to a period of lower but more sustainable growth. This can only be good for all its trading partners.
Based on the latest fund fact sheets, funds such as Pheim Asia ex-Japan Islamic Fund, Pheim Asia ex-Japan Fund, and Pheim Emerging Companies Balance Fund have cash positions of more than 23%. Can you explain the rationale for this high level of cash holding?
In the month of May to June period, we felt that there was not much value in the markets as most regional markets were beginning to come off their highs. For example, in the month of June, the month-to-month performance of the regional markets recorded falls between 1.8% and to 12.1%, except Malaysia. Coincidentally, the Fed Chairman Ben Bernanke also mentioned towards the end of May that the Fed could begin winding down its QE3 program if economic data continues to improve, and this triggered a further sell down in the regional markets. We saw this as a good opportunity to take profit on stocks that have performed well in our portfolios and which had outrun their fundamentals. Our high cash position is temporary. We continually assess the market outlook and look for undervalued stocks meeting our investment criteria, to which we will redeploy the cash. These portfolios are well positioned to accumulate undervalued stocks in the near term as we continue to look for stocks with low PE, low gearing and strong prospective growth.
What is your advice for investors looking to invest or are currently invested in the Asia ExJapan equities?
We feel that the profit taking in the Asia ExJapan markets may continue for a bit more, since most of the markets in the region have corrected in the range of 2.9 to 21.8% from their highs in the last 52 weeks. Indonesia, Thailand, Philippines and Hong Kong being among the worst performers in the region. However, we do see values emerging lately. Given the prospect of a US market recovery being firmer going forward and the China's market recent correction that has improved its valuation, investors may revisit some of the companies in this region that have dropped sharply. Earnings expectations are now so low that we think companies may actually surprise on the upside in China. We will be looking out for companies that possess sound fundamentals in this region and that have fallen sharply from their recent peak.